What do you think is wrong? Are analysts just yet to catch up with the whole picture? Have they not factored in inflation and margin compression?
I think you're spot on there, Matt. Look, analysts are kind of listening to companies, and companies will tell you what's kind of just happened or maybe what's just happening immediately. But you have to really look forward, and that's what the equity market's doing. It's looking forward, and it's telling you that there is likely an earnings recession coming. And I think, that's my kind of base case now, that we have an earnings recession coming. This is not, we don't believe, a GFC type bear market. This is more of a cyclical standard kind of type bear market. So from an earnings perspective, I would be expecting earnings to be coming down somewhere in the region of 10 to 15%. There is not the big imbalances out there that would really justify a bigger reduction in earnings at the moment.
What about a bigger reduction in prices, though, Nigel? You have Mike Wilson over at Morgan Stanley saying the S&P needs to drop another 15 to 20% to about the 3,000 level to accurately price in the growth risk, the economic contraction we are facing. What is priced in? What is enough?
I think he's probably about right, Kayleigh, to be honest. I'm looking at 3,000 on the S&P 500 as an area where you really want to start thinking about buying then. If you look at where the S&P 500 is on a Shiller basis, it's still pretty expensive, and it has to get back to the 3,000 level to get you to the long-term median, which is around about 24 times on a Shiller PE. So to me, the S&P is still an expensive market. Remember, we were back at 3,000 in December 2019, so it's not that long ago. It seems, we've had a very strong market. I think we've probably still got further to go.
And over here in Europe then, Nigel, I know that the banking sector is something that you're watching closely. You like the banking sector here in Europe. Is that based on higher rates? Is it all about share buybacks? Is it all about M&A, or all of the above?
We do like the bank sector in Europe. Look, one is it's really cheap. Second is the balance sheets are in pretty good shape. You've got cash share buybacks coming. You've got higher dividends as well. And I think everybody has a kind of muscle memory of the GFC, and this is terrible for the banking sectors. But actually, banks can outperform in a relatively moderate recessionary environment. And I think that's the kind of environment that we're thinking about. So we do see that sector as being attractive. It's also a sector that is pretty underowned. A lot of people have avoided that sector. And just on the European market overall, the European market is actually back at its long-term average in terms of the Shiller PE, whereas the US, as I mentioned, is still 20% expensive. So I think Europe is looking attractive from a valuation perspective, but there's still a lot of uncertainties related to the war, related to potential recession there.